Imagine logging into your brokerage account, seeing your wealth accelerate on a perfect upward curve. This chart plots exactly how that accelerating timeline works in practice. It took nearly 1,000 days to add the first £100,000 to this portfolio. The next 100,000 arrived in 500 days. By the time it hit 700,000, the gap shrank to only 252 days. At this rate, reaching a £1 million retirement looks like a mathematical certainty, hitting 7 figures years ahead of schedule. On paper, this growth curve looks like undeniable proof of a flawless strategy. It suggests that active management is the key to outsized returns. But starting with an initial pot of £438,000, managing that curve requires constant effort. Over 3 years, analyzing endless reports, timing the market, managing the stress of trading, you follow a strict playbook. You stick to indices you've identified as cheap, and you refuse to own European stocks, hoping to avoid regional economic slumps. You move your capital into Asian technology, betting heavily on the manufacturers driving the expansion of artificial intelligence, companies like TSMC, Samsung, and SK Hynix. This bar chart compares those active results against a standard global portfolio with an 80-20 split of shares and bonds. Your specific market calls outperformed that traditional baseline by a factor of 6. These returns suggest that active market timing is the ultimate way to build wealth. But there is a possibility that a different variable is driving the success. To find out, we can look at a parallel timeline starting on the exact same day 3.5 years ago. In this second timeline, you build a phantom portfolio. You simply split your money equally between 4 broad categories: a UK index, a global tracker, some regional Asian funds, and cash. Then you set one rule. Once these assets are purchased, you never touch them again. You make 0 trades for the next 3 years. While you were enduring the endless analysis and stress of active trading in Timeline A, the phantom portfolio in Timeline B sat completely untouched. After years of active management, the final tally for Timeline A sits at £707,563. In Timeline B, doing absolutely nothing resulted in £699,420. The margin is almost non-existent. All that relentless trading generated less than £68 of added value for every month of effort. This happened because a massive global rally lifted nearly all equities. When the entire market moves up, the specific stocks you pick matter much less than just being in the market. This is the philosophy of investors like Warren Buffett. For most people, long-term, disciplined inaction is the most reliable way to accumulate wealth. In standard conditions, active trading is often just an exercise in ego, where we mistake a rising tide for our own investing skill. A hands-off, passive approach is the most efficient foundation for building a portfolio, but that rule assumes the market is growing at a steady, predictable pace. It becomes less effective when a massive amount of new capital enters the financial system all at once. We are approaching one of those moments now. Several of the world's largest private companies, including SpaceX, are preparing to go public. These listings include the major players in artificial intelligence, such as Anthropic and OpenAI. The scale is difficult to overstate. Analysts expect $4 trillion of new market capitalization to enter the system. To put that in perspective, the entire S&P 500 is only about 20 times larger. This is genuinely new money entering the ecosystem. Unlike a typical market rotation, where buying one stock requires selling another, this influx expands the total market cap of global equities significantly and all at once. Passive investing works because it tracks established markets. But when new companies, equivalent to exactly 5% of the S&P 500, arrive in a single wave, they will dictate the market's direction for years. In these rare moments, the risk of waiting for an index to catch up can outweigh the benefits of doing nothing.